Traditional dividends pay 2 to 3%. But what if I told you some ETFs are paying 8%, 12%, even 32% in monthly dividends? Today, I'm breaking down the 5 highest yielding covered call ETFs and showing you exactly what $50,000 generates in each one. We're talking $341 a month, $475 a month, and one that pays over $4,000 monthly. But here's what separates the smart investors from the ones who lose money: understanding the one mechanism that most people completely miss. In this video, I'll show you the real math behind these ETFs, the insider secret your financial advisor won't tell you, and exactly who should and absolutely shouldn't invest in these. Stick around, because at the end, I'll reveal the portfolio balance formula that lets you generate high income without slowly liquidating your account. If you want real strategies for building wealth faster, hit that subscribe button. Let's dive in. Before we jump into the numbers, let me explain how these ETFs generate such high income using a simple story. Imagine you own a rental property worth $300,000. You collect $2,000 a month in rent. That's about 8% annually. Pretty solid. Now, what if a developer offered you an extra $500 a month to have the option to buy your property at $350,000 if prices skyrocket? You get immediate extra cash. But if your property jumps to $400,000, you cap your gain at $350,000. That's exactly what covered call ETFs do. They own stocks like Apple, Tesla, or the entire S&P 500, and then sell options on those stocks for premium income. You boost your monthly cash flow significantly, but you give up some explosive upside potential. For income investors who want dividends now, instead of hoping for a 200% gain in 10 years, that's actually a great trade. And that brings us to the money. And stick around, because after I show you these 5 ETFs, I'm going to reveal why one of them pays 100% yield, but has actually destroyed 64% of investor capital since launch. Understanding this difference could save you from making a $50,000 mistake. Let's break down exactly what $50,000 generates in each of these funds. I'm going to start with the most conservative option and work our way up to the most aggressive. If you're new to covered call ETFs, or you want something that won't keep you up at night, start here. JEPI is managed by JP Morgan and tracks large cap S&P 500 stocks, companies like Microsoft, Johnson & Johnson, and Procter & Gamble. But instead of just collecting the tiny dividends these companies pay, JEPI sells covered calls on top of those holdings to generate extra income. The current yield sits at 8.18%. Now let's do the math. If you invest $50,000 in JEPI, you're generating $341 per month. That's $4,090 per year. Maybe that doesn't sound like life-changing money, but think about it this way. That's a car payment covered. That's groceries for a family of 4. That's a nice vacation every year, funded entirely by your investments. And here's where it gets interesting. Over 10 years, assuming the yield stays roughly the same, that's $40,900 in dividends. And over 20 years, that's $81,800. Over 30 years, that's $122,700. And you still own your original shares. What makes JEPI special is that it's actively managed. That means JP Morgan's team adjusts the strategy based on what's happening in the market. If volatility spikes, they can dial back the covered calls. If the market stabilizes, they can get more aggressive. You're essentially paying for professional risk management, and for a lot of investors, that peace of mind is worth it. Now, if JEPI is the conservative older sibling, JEPQ is the ambitious younger one who works in Silicon Valley. JEPQ uses the exact same strategy as JEPI, but instead of targeting the S&P 500, it focuses on the NASDAQ 100. We're talking Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, the tech giants that have been driving the market for years. The current yield is 11.41%, which is significantly higher than JEPI. Let's run the numbers. That same $50,000 investment now generates $475 per month, or $5,705 per year. That's $134 more per month than GPI, which adds up to an extra $1,615 annually. Over 10 years, you're looking at $57,050 in dividends. Over 20 years, $114,100. Over 30 years, $171,150. But here's what really caught my attention. JEPQ returned 24.89% in 2024. That's not just good, that's exceptional for a covered call ETF. Most of these funds trade growth for income, but GPQ managed to deliver both. Why? Because tech stocks had an incredible run in 2024, and GPQ captured a lot of that upside while still generating monthly income. Now, does that mean it'll do 24% every year? Of course not. But it shows you that with the right market conditions, you don't have to completely sacrifice growth to get income. GPQ is ideal if you're in your 40s or 50s, you believe in the long-term dominance of tech, and you want a higher income. Now, the next 3 ETFs pay even higher yields, but there's a 118x discrepancy between what one of them pays out versus what it actually earns. I'll show you exactly what that means and why most investors completely miss this red flag. Keep watching. All right, now we're stepping into more aggressive territory. QYLD takes a different approach. Instead of being actively managed like JEPI and JEPQ, QYLD passively tracks the Nasdaq 100 and mechanically writes covered calls on the entire index every single month. No human discretion, no market timing, just a systematic strategy designed to generate maximum income from tech stocks. The current yield is 11.8%. Let's do the math again. $50,000 in QLD generates $491 per month, or $5,900 per year. That's nearly $500 a month in passive income. Over 10 years, that's $59,000 in dividends. Over 20 years, $118,000. Over 30 years, $177,000. What's impressive about QYLD is its track record. This fund has been paying monthly dividends consistently for over 12 years. Through bull markets, bear markets, the COVID crash, the 2022 meltdown, it kept paying. That consistency is what attracts income-focused investors who just want reliable cash flow every single month. So, who is QYLD for? Retirees who don't care about growth anymore. People who want to convert a lump sum into a monthly cash flow. If that's you, QYLD delivers exactly what it promises. XYLD is basically QYLD's more diversified cousin. Same strategy, same passive approach, but instead of focusing on the Nasdaq 100, XYLD targets the S&P 500. That means you're getting exposure to all 500 companies across every sector: tech, healthcare, financials, energy, consumer goods, everything. The current yield is 12.74%, which is the highest among broad market covered call ETFs. Let's run the numbers. $50,000 in XYLD generates $530 per month, or $6,370 per year. That's more than $500,000 hitting your account every single month. Over 10 years, you're collecting $63,700 in dividends. Over 20 years, $127,400. Over 30 years, $191,100. Here's why XYLD appeals to certain investors. It's the most diversified option on this list. You're not betting on tech dominance like you are with QYLD. The downside, XYLD has one of the highest payout ratios in this entire category, 346%. What does that mean? It's paying out 3.5 times what it actually earns from its investments. We'll get into why that matters in a minute, but the short version is this. You're not just earning income, you're also converting some of your capital into income. For retirees who are intentionally drawing down their portfolios, that's fine. For younger investors trying to build wealth, it's a problem. All right, the next ETF is the one everyone asks about. It pays nearly 100% yield annually. Yes, you'd get your entire $50,000 back in just 12 months. But there's a dark side to this that Wall Street doesn't advertise. Don't skip ahead, because what I'm about to show you is critical. Okay, now we get to the one that makes financial advisors lose their minds. TSLY doesn't invest in a broad index. It focuses on one stock, Tesla, but it doesn't actually buy Tesla shares directly. Instead, it uses a synthetic covered call strategy with options and treasury bonds to replicate Tesla's price movements while generating massive income. The current yield, 99.92%. Let me say that again, nearly 100%. If you invest $50,000 in TSLY, you're generating $4,163 per month. That's $49,960 per year. You would essentially get your entire investment back in dividends in just 12 months. Now, before you run to your brokerage account, let me hit you with the reality check. TSLY launched in November 2022. Since then, the share price has dropped 64%. Yes, you read that right. If you bought at inception and didn't reinvest your dividends, you lost nearly 2/3 of your capital. But here's the twist. If you did reinvest those dividends, your total return would be around 17.55% annualized. This perfectly demonstrates what I'm about to explain in the next section. High yield doesn't always mean high income. Sometimes it means you're just getting your own money back in a different form. So who should even consider TSLY? Only aggressive traders who want short-term Tesla exposure with extreme income and fully understand they're playing with fire. This is not a buy and hold forever investment. This is a 5% position max for someone who knows exactly what they're doing. If you're looking for stability, safety, or long-term wealth building, TSLY is absolutely not for you. Now here's the insider secret that separates the investors who build wealth from the ones who slowly liquidate their accounts without even realizing it. These high yields come from something called return of capital. Let me show you what that actually means with QYLD as an example. QYLD pays an 11.8% distribution yield. Sounds incredible, but here's what most investors don't check. Its SEC yield is only 0.10%. That's a 118 times difference. What does that mean? The SEC yield shows what the fund actually earns from its investments. The distribution yield shows what it pays out to you. When those two numbers are that far apart, it means most of that 11.8% isn't true earnings. It's your own money being paid back to you. You're not getting rich. You're converting your capital into income. So does that mean you should avoid these completely? Not necessarily. There's a specific type of investor who can use these brilliantly, and I'm about to show you exactly who that is, plus the portfolio allocation formula that makes this strategy actually work. This is the difference between winning and losing with covered call ETFs. Here's the truth. If you're 25 years old with a 40-year investment timeline, covered call ETFs are probably not for you. You're giving up too much growth potential. Just invest in a standard S&P 500 or NASDAQ index fund and let compounding do its thing. But if you're within 5 to 10 years of retirement, or you're already retired and need a monthly income, these can work beautifully if you do it right. The key is understanding your goal. Are you trying to grow wealth, or are you trying to generate income from existing wealth? If it's the latter, and you're willing to accept some capital erosion in exchange for high monthly cash flow, these ETFs make sense. And here's the smart play. Don't go all in on one. Diversify across 2 or 3 of these. Keep them to 20 to 30% of your portfolio max. And for the ultra-high yielders like TSLY, limit them to 5% or less. The investors who succeed with covered call ETFs are the ones who understand they're not chasing 10x returns. They're strategically engineering monthly cash flow from existing capital. And when you frame it that way, these ETFs deliver exactly what they promise. Now smash that like button. Subscribe for more real strategies on building wealth. And watch this video next, where I break down exactly how to build a $5,000 per month passive income portfolio using dividend strategies. One last thing, this is educational content, not financial advice. All investing carries risk. Do your own research and consult a professional before making any investment decisions. Now you've got the knowledge, go use it wisely.